Hello, everyone, and welcome back. I am Nicole Payne, CMA, and I'm here today to drop some accounting truth bombs. If you've been around Pixel for a while, you know that we like to crack jokes to ease the tension. Usually those jokes are at our own expense. That's where the title of today's video came from. Not too long ago, I received an email from a client who was looking for an easy way to assign value to his company so that he could potentially sell some of his company off to an investor. My response listed off several ways that you can value a company to include a multiplier of EBITDA. I explained what EBITDA was, but the client came back and his only response was, EBITDA? What the fuck? And that's where this came from. It made me realize that accounting really is a language all of its own. And to the average person, they don't necessarily know how to speak Accountantese. So that's where I'm coming in. I'm going to do a video series on how to speak Accountantese. And so this is the first of many. Hopefully it will be well received. But to talk a little bit about Accountantese, let's talk EBITDA. What is EBITDA or EBITDA? The way you pronounce it usually is determined by where you're from, but we won't talk about that because it's a little controversial. EBITDA literally is an acronym that means earnings before interest, taxes, depreciation, and amortization. So why is EBITDA important? Why do so many people talk about it? Why is it something that you would consider basing the price tag on your company on? And let's back up a little bit. Depreciation and amortization are expenses that you have to report in any given period, but they really don't have anything to do with what you're doing in that period. They're set in advance, based on money that you've spent well beforehand, and you have to recognize them in a very specific way in order to follow accounting standards or tax guidelines. Interest and taxes are also something that based on something that happened perhaps years ago or in other periods that you don't have a whole lot of control over them. It's money that literally has left your bank account in that particular reporting period, but you don't have a way to control how much you had to spend, whether it's the government reaching into your pocketbook or a bank account or a bank that loaned you money reaching into your bank account. You had no control over it, or very little at least. So the EBITDA is really more geared at telling you how the business operated in that period, looking only at the costs that you had significant control over. Sometimes this is also called operating profit. And if your chart of accounts is set up the way it should be, the way that we structure all of our chart of accounts, it's very, very easy to find what your EBITDA is. Again, if you're in QuickBooks, the P&L report has net operating profit or net operating income right there at not the very bottom, because there's things below it, and those things below it are what make up the EBITDA, the earnings before. So anything below net operating profit should be interest, taxes, depreciation, and amortization. So why do you care what it is? It's a good indicator of financial health to know that you're making a profit when you are only looking at the revenue that you've brought in compared to the expenses that you have control over. That's today's lesson on Accountantese. If you have anything that you're interested in learning about, that you've heard an accounting term thrown around and you're not quite sure what it is or why it's important, drop it in the comments and I will try to address it in a future video. Until next time, like, subscribe. You can hit us up on YouTube, Facebook, LinkedIn, wherever you see this video, and we will see you on the next one. Take care, everybody.